Chevron shares are higher by about 2% this morning after the company reported earnings that beat estimates by a lot, but revenue did fall a little short. Joining us right now is Mike Wirth. He is Chevron CEO. And, Mike, I got to tell you, I always appreciate talking to you around earnings, but I think I'm more eager than ever to hear your perspective on so many things that are happening in the world right now. It's great to see you. Thank you for joining us.
You bet, Becky. It's great to see you.
Okay, so let's talk through first the earnings numbers, because you beat by a lot. I think it was $1.41 versus the 95 cents that the street was expecting. But revenue was below what the street was expecting. So what happened? Why that higher profit? What was the secret?
Becky, it was a quarter where we had strong U.S. production, record U.S. refinery runs, and the resilience of our portfolio really showed through. This is the third consecutive quarter of U.S. production greater than 2 million barrels a day. We're up 500,000 barrels a day year on year, from, in round numbers, 3.5 million to 4 million barrels a day globally. And we had record U.S. refinery throughput at a time in March when markets really needed it. And we've got less exposure to the Middle East than some other companies in our industry. It's less than 5% of our production. So all of those things combined with good execution from our people delivered a very, very strong quarter.
Yeah, I wanted to dig in a little bit on your Middle East production, because I had read from an analyst report that it was even lower than less than 5%. Something like 1% of your production is from the Middle East. So you're not impacted in the same way. I think Chevron has about 20% of its production that's being held in right now in the Middle East. Explain how you are the least impacted by this.
Well, our portfolio is global. It's diversified. We have big positions in countries in North and South America, in Asia, in Africa, and just less exposure to the Middle East than some of the other companies in the industry. We've got production in a couple of countries there, in Saudi Arabia and Kuwait. We produce a lot of natural gas in Israel, but our operations there have been much less impacted, and it's a much smaller part of our portfolio than it is for some of our peers. So our production and performance around the world was very strong. The impact that we feel from the events in the Middle East on our company is relatively less than others, and I think that's really what combines to deliver that performance.
We are looking at oil prices at the highest level in about 4 years, and the spike has been quick. It has been very sharp. It has been very volatile. I know you don't have a crystal ball, Mike, but you certainly know a lot more about what's happening with oil prices than we do. Walk us through where you think prices are headed, how long you think this lasts, and obviously a lot of that depends on how long the Strait of Hormuz is closed. But what's your best guess at this moment, or maybe what are the contingencies that you all are planning for?
Well, the global energy system continues to be under extreme stress. The world consumes about 100 million barrels of oil a day. Roughly 20% of that typically flows through the Strait of Hormuz. 20% of global LNG supply comes from the region and also transits through the strait. So as that has become closed off, and there are few options to reroute around that, what's happened is the world is very short on supply. Now, the energy system normally has some shock absorbers built into it. We have inventories on land around the world. We have inventories on the water around the world, and those both were relatively high coming into this year. Production had been strong globally. There was a lot of oil on the water due to sanctioned barrels that were moving around in what's referred to as the dark fleet or the shadow fleet, so more than we would typically see. And then countries also have strategic reserves, the U.S. and others do. And so in normal disruptions, these tend to buffer price action because you can pull from those reserves as the disruption is dealt with and things return to normal. And so it tends to buffer the price signal into the market. As those shock absorbers get drawn down, there's less ability for them to actually absorb the shock. And so the price signal gets stronger. And right now, because supply is short and demand continues to be strong, what we see is this upward pressure on prices, markets have a hard time looking out into the future and really having a good view on when things get resolved, when these inventories can be rebuilt and the flows are returned. And the longer this goes on, I think the more acute the situation becomes. And so that's why you see this kind of steady upward move in prices. And I think until flows are resumed through the straits, we're going to continue to feel this pressure and be exposed to more upside movements.
Mike, let's just kind of play this out. If the Strait of Hormuz is closed for, let's say, another month, where do you think oil prices are headed? If it's closed for another 2 months, and is there a point, a breaking point, where some of these reserves you've talked about, oil that's floating on the water or oil reserves on land, run out and there's an extreme pressure situation?
Well, that's certainly the scenario that we're concerned about. A month from now, 2 months from now, it's difficult to predict price because this is a situation we don't have good analogs for historically. But as those inventories get drawn down, the price has to go up because supply and demand ultimately have to meet. And price is what will start to allocate that supply. Now, it's the price of products that truly is traded in the market that will result in that. And we're already seeing now, jet fuel prices, diesel prices in Asia, in Europe at very high levels. We're starting to see some signals that demand is being reduced in some of those markets. And if we don't get supply reestablished, demand will have to come down across different sectors of the economy. And that's, I think, the big concern that everybody has, is that we try to avoid a scenario where that becomes extreme.
You were at the White House just 2 days ago, speaking with the administration about what's happening in the world, also about Venezuela. What did you take away from that meeting? How prepared are we for any of these situations? What did the administration ask you?
Well, the administration had good questions about specific aspects of the energy situation. We meet with administration officials regularly, speak to them on an almost constant basis in a time like this. And they're looking to understand how the markets are supplied, what kinds of actions can be taken to help reduce some of these pressures and receive input. I can't comment on the specifics, but I can say that the dialogue was very open. The questions were good, and we continue to provide information on almost a real-time basis to help them assess the impact on the economy.